for each of these, there's a transaction that will happen. We're going to put in how this would impact our balance sheet. So whenever we're on a transaction, we want to say, okay, what's going to happen now? Well, let's go ahead and get started, and we'll kind of make some notes about how this also works. I'm going to change something here. Hold on a second. I got to stop sharing my screen for a second. Share. Oops, that's not what I want to share. There we go. Okay. So, on this first one, use cash to purchase land. So, what is going to happen to our balance sheet? Well, let's take the easy one. What's going to happen to cash?
It's going to go down since we used it.
Yep. So cash will go down by 300. And what else is going to happen?
The land is probably going to increase.
Yep, exactly. Perfect. So this land is going to go up by 300. So our new ending balance here would be still be 800. Yeah, you just copy and paste if you want on these. I did this wrong. I'm sorry, change this. What did I do wrong? I added the cash instead of subtracting it. I'm sorry, change that. It should be 700. Okay, so here's our transaction that we had. Now, because these are both on the same side, when I add these up, they should be the same. And then all these over here will still be the same. I'm going to enter these. These, you don't have to put those on that side. We didn't do anything on that side, but there will still be the same 1,200. So over here, now hopefully this will come out to be 11,200, and if it doesn't, then there's a problem. Okay, that comes out to 11,200, so we still balance. So actually, our assets didn't change at all. You know, we purchased land, our cash is less, but our land is more, so it's kind of a wash. Okay, 1B. Similar one. Pay cash for equipment. Cash would go down. And let's see what else would go. Equipment would go up, right? $42.90 plus 400. What is that? $46.90.
Yeah.
Hopefully all that adds up. $14,000. 60. This side didn't change. You really don't have to do this, but I'll put it. Oops. And that should be exactly the same. So again, this is another transaction that it doesn't change the total assets, but you have less cash, you have more equipment. Okay, 2 is a little bit of a tricky one. The supplies is okay. All right. Well, let's take the easy one. What's happening to supplies? Is it going up or down?
It's going up.
Yep. So supplies are going up by 200. What other account do we need?
Payable.
Good. Yeah, the accounts payable. And here's the tricky part. The accounts payable, are they going up or down?
Up.
Up. Good. Yeah, we owe more now. We owe $200 more. Can you guys see my screen? I'm getting things flashing. Okay, I mean, you can see my document here. Okay, so all right, I'm just going to ignore it then. $690 plus 200 is $890. Okay, so this should actually come out to be what, $200 more than that, right? We added 200 to the side, so it should go up to like 13,080. Make sure it does. Oh wait, take away from the thing here. Okay, so this is. Yeah, so it's 13,080. You kind of knew that, you know, this is, if you had 200 in the assets, it's going to bump that up by 200. Now, same thing's happening on this side. We no longer owe 1380, we owe 1580. So this side should be the same. $13,080. Okay, so changes both sides of the equation of the balance sheet. Our supplies go up. So does our liability. So we owe 200 more now. Instead of 1380, we owe 50. Okay, what are we going to do with this one? There's a building and land using a $3,000 mortgage. The building has a value of 2,000, and the land has a value of 1,000. So building 2,000, land 1,000.
First thing we're going to do is add 3,000 to mortgage payable.
Yep. Okay, so mortgage payable, 3,000 more. What else?
The building is gonna be increased by 2,000 and the land by 1,000.
Yep, perfect. Hey. What's that, 8,400? All right, now this should probably come out to what? When we had 3,000, 20,920, if I do it right. Yep. So 20,000. 20, which is what you'd expect. You know, if you get 17,000 of assets and you add 3,000, I'll put it by 3,000. Okay. And my transaction thing isn't right here. Okay, so this would be mortgage is now 7,800. Yeah, so this would change both sides here. Now you'll notice something. Because the balance sheet has to balance, you're always going to have at least two accounts. Now you may have more, slash we have three, but you always have to have at least two accounts, because if you just add something to one account, it's not going to balance. So there always has to be at least two. And sometimes our accounting system is called the double accounting, double entry accounting, because you have to have at least two entries, or else it's not going to balance. You can have more than two. We just did three, but you got to have at least two entries to make it balance. There's my calculator. Oh, doesn't it look happy? All right. Back here. Okay, so let's go through. Okay, borrowed cash from the bank using a mortgage payable of $5,000. What would that look like? What accounts are you going to use?
Well, you're gonna have to do things to cash in your mortgage payable account.
Yep. So our cash, is it going up or down?
Up.
Up. Good. So we borrowed the money, and it's tempting to say, okay, wait, this is a liability, so this is negative. You're going to have to pay it off eventually, but when you take out the loan and they give you the cash, your cash is going to go up. So for whatever you're going to use the cash for, I don't know, but at least initially your cash will go up. And mortgage payable, up or down?
Up.
Up. Good.
Down.
It's actually going to go up because we're going to owe more. Now, it's sort of like more of a negative. We're going to have to pay off more when we pay off the mortgage. They're going to pay off $5,000 more. So now eventually your cash is going to go down, but the mortgage payable itself is how much do we owe? And so this will actually go up by 5,000. So this is going to increase how much we owe. So we no longer owe 6,300. We owe what, 11,000? Something like that. And by the way, if you don't want to transfer all these over, you can just leave it, like that if you want. Just add in the changed one. As we go through these, you're probably already thinking, man, there has got to be a better way to do this. This is really cumbersome. So start thinking about if we just wanted to do the transactions, what would we really just need to do that? Right. Hopefully both of these will come out to be the same. Okay. So we borrowed the cash. So our cash goes up, maybe we borrowed it to keep the place going or whatever it was. But now we owe more money. We owe $5,000 more. So our cash goes up, our liabilities go up, and they both equal. So by 5,000, then by 5,000. Okay. Oops. Something wrong here in this space. Okay. Oh, this one's tricky. And this one is tricky for a number of reasons. First of all, the term issued is a little bit deceiving. When they say they issued stock, what this means is that they sold it. So when they say issued, they mean they sold the stock. And the stock is, they're selling ownership in the place. So these are actually two kind of, actually, the one I sent you guys now, I don't think this is even the right one because this is, I had fixed all those. Okay. So they issued common stock for cash 2,000. So, okay. They sold common stock. Well, if you sell anything, what happens to your cash? Does it go up or down? If you sell something.
Down.
I think it goes up.
Yeah, if you sell something, you're selling it to somebody else. So somebody else gets something and they'll give you cash for it. So in this case, they're giving us cash, 2,000 for our stock. We sold them some of our ownership of the company. So our cash is going to go up. 2,000. And our common stock down here. So now we sold more. So do we have more owners or less owners now? We sold part of the business, part of the company.
Will it be more?
More, exactly. More people, either more people own it or whoever else, if there was before, now they own more of it. So yeah, so this would be a plus. So we have $2,000 more of ownership. Everything else is the same. All right, and this should be probably what, 2140, I think, in 2000. Okay, and over here, accounts payable the same. That's the same. Yeah, I'm gonna change this to the same. I did something really wrong. Hold on, let's try this again. There we go. Okay. For A, received cash from a customer previously billed. What accounts are we going to use for that one? Or what's one of the accounts?
Wouldn't it be accounts receivable?
Yep. And what's the other one?
Cash.
Yep. Okay, so let's take the easy one. Let's take cash. Is cash going up or down?
That's going up because they're billing you the money by 500.
Yep. Our cash is going to go up. Accounts receivable. Up or down?
Oh, it's going up.
Actually, it's going to go down. Here, do they still owe us $960? No, whoever our customers are, they owed us $960, but they paid off 500 of it. So this is actually going to go down by 500. So we got the cash, but now they don't owe us 960. They owe us 500 less than that. So this would be 1,200 plus 500 is 1,700. And 960 minus 500 is 465. All the rest of these are the same. Oops. And that should be the same total, right? Because it's plus 500 and minus 500. So $13,440. This one, everything would be the same. All right. So this is when we billed the customer previously, but now we've collected that money, so they don't owe us that anymore, but we got the cash. Which honestly, we'd rather have the cash in mind. So it's good. 4B is exactly the same. Customer paid cash towards their account. This is another way of saying the same. I think I pulled this out of the book. I think the book had a couple different ways of saying, they paid on their account. I did that wrong. Let's try that again. Plus 100. Here's minus 100. come out exactly the same. Yep. Yeah. These will be the same. Okay. $5A, paid off a few of the accounts payable for $400. What did we probably pay with?
The cash.
Cash, good. Is the cash going up or down?
It's gonna go down.
Good. Whenever you see paid, think of cash. So when you see paid, think cash. Or you pay things off, you pay them with cash. Okay, so our cash is going to go down by 400. What is that, 1,800? Okay, what else are we going to have? Accounts payable.
Payable is gonna go down too.
Good. Yeah, excellent. So now we're paying off these accounts payable, so we don't owe as much as we owed before. So this would be minus 400. We just paid off. We owed 2,600. We just paid off 400 of it. So now we owe 122. 240. Okay. Oops. $4,240, and that's what we. That's what we expect because it'd be $400 cheaper, less than this. And chicken would be the same thing over here. Yep. Five B, made a payment towards the mortgage payable $1,000. Ignore the interest expense. Okay. Same as the other one. We need payment. It's going to tell us that that's cash. So paid or payment. So they're paying cash. So that would be minus 1,000. Oh, wait, I still got another one to do. Mortgage payable is going up or down?
Down.
Down. Yep. Perfect. So we're paying off some of that mortgage. We don't owe as much on the mortgage. Okay. $680, that's what we'd expect it to be. 1,000 less than that one, right? And over here. Now we no longer owe 4,200, we owe 3,200. I don't know whoever this owes that. $680. Okay. All right, so that's the first handout. Save it. You'll notice something though about this, that you could probably do this a lot more efficiently. Right. I mean, there's some things that we did here that we really probably don't need to do. If you just want to record this transaction, what are the only accounts you really need? You know, for instance, you record this transaction, they made a $1,000 payment. Do you need accounts receivable? Do you need supplies? Do you need equipment? Do you need to record this transaction? Do you need that? No, nothing happened to those. So all you really need to do this transaction are these two accounts and the total, and the amounts. If you want to just record this transaction, that's all you really need, right? I mean, the rest of it is the same, exactly the same as it was before. You really don't need to change anything there. So these two are really the only thing that you need: the cash and the mortgage payable. This is all you really need. And even if you think about it, even more so is that if you're just going to record the transaction, you really don't even have to do the totals. If your only job was to record this transaction, you just say cash went down by 1,000 or mortgage payable went down by 1,000. That's it. That's all that happened. Now you don't know what if you didn't need to know what the ending balances were, you could just record that, and that's what we're going to do next in part 2. Okay, we should probably take a break. Hold on a second. Mr. Calculator. So it is 6:59. How about 7:05? We'll come back and we're going to start on the chapter 2 handout part 2. And we're not going to finish it, right? And we're going to find out how to do these entries a little more quickly, a little more efficiently. So go ahead and take a break, and we'll come back at 7:05, and then we'll start in on chapter 2. And I am going to make sure that I give you guys the right chapter 2. Before I do anything. Yeah, I did. Okay. All right. Okay, so the part two, and part two is the handout part two is really going to be sort of what we're going to do from now on as far as putting in the journal entries. The end of the way we did it in part one, nothing wrong with it. It's just a little bit cumbersome. And, you know, if we're doing a handful of journal entries, it probably wouldn't be a handful of, you know, transactions, where it probably wouldn't be that big a deal. However, if you had to do 100 of them, that would be no fun at all. So, you know, the question is, well, how can we make this quicker? You know, if we're going to record these transactions, how do we do it quicker? And that's basically what we're doing in chapter chapter 2, part 2, I should say. Let me make sure I got the right one up here. Okay. So this is a little bit of history on journal entries. They used to be journal entries. You would actually write them out. They were written. You know, when a transaction happened, they would sit down and write out what the transaction was. You know, they'd be paragraphs long. Just the term journal, just like you'd talk about like entries in a diary or something. You know, you kept your journal. Same thing. That they would just record everything by writing down exactly the transaction that happened. Eventually, they started saying, "Okay, well, wait a minute. They're still writing quite a bit here, but they're saying, okay, we only need to take certain things. Okay, you don't need to write this whole book thing here. We'll just take basically the accounts that we need, write in the amounts. These are, I don't know what they're in, lira or something. Yeah. So, you know, we'll simply take the accounts we need and put them in the system. Now, this is a double entry system because they said, okay, just like we did before, it had, you know, to balance it, you have to have at least 2 of them. So they've already started, like 400 years ago or so, they've already started to reduce the writing, you know, just make it more quickly write it down. All right, so coming down here to page 2, and on page 2, I'm going to move this thing. Okay, on page 2, you'll notice this transaction. I think this is the same transaction we had on for the first one, 1A, I think. But use cash to purchase land, $300. And so here's the accounts that we needed. We need cash. We need land. The cash went down and the land went up. And down here is the journal entry for it. And you'll notice that we have debits and credits. All right, so here are the 2 accounts. Here are debits and credits. And so the question becomes, well, how, you know, what is this all about down here? What is this? That is somebody's shorthand for how to record a transaction quickly. Just recording the transaction, that's all it is. Now, one of the things we have to figure out is how do we know what gets debited and how do we know what gets credited? And forget everything you know about debit cards and credit cards and all that kind of stuff. It's not going to have any impact on what we're doing. If you look at pages 9 and 10 of your handout, let me pull this up. So page 10, you have something that looks like this. You know, it says if you have expenses, they increase and decrease and all that. It's just something like you'd see in the book. But page 9 is what I'm going to, I think, focus a little more on. in page 9 actually has the accounts in there. We're gonna need. So you can see we have cash. You know, these are assets. Cash, inventory, I don't think we talked about prepaid. There's a few new ones. Patents, copyrights, we haven't talked about those. Liabilities. These are kind of liabilities. And the thing that is important here is assets, they increase with debits and they decrease with credits. Okay, so they increase with debits, they go up, they decrease with credits. Now, let's look at liabilities. Liabilities are a little bit different. They increase with credits and decrease with debits. It's just the opposite. So, if you're wondering, do debits increase the account? Well, it depends. If it's an asset, it increases the account. If it's a liability, it decreases it. And so on and so forth. So, going back to this, so you really can't say, okay, if it's a debit, the account goes up, because, over here, it does just the opposite. And you say credit, credit means it goes down. Well, over here, it goes up with a credit. So it depends on the account. What kind of account it is makes a difference. So that's why we have to know these accounts and know, to know which ones that are going up or down and all that kind of stuff. Okay, so let's get back to our equation here. So we have cash going down and land going up. So let's go to let's do the cash first. So cash is decreasing. So cash is decreasing. It'll decrease with a credit. And you'll see that here. So the cash, it's an asset going down. It's going to decrease with a credit. Land is an asset going up. So land, an asset, is going up with a debit. So it depends on which kind of an account it is, whether we debit it or credit it. Okay, let's go down. Let's go to number 2 here. Okay, paid cash for equipment. So which accounts are we using?
We're using cash.
Yep.
And then I think equipment.
Yep. So we got cash and we have equipment. You're absolutely right. Okay, the cash, is it increasing or decreasing?
Decreasing.
Yep. Very good. Equipment?
Decrease.
Yep. So here's we have this journal, and this is, I think these are some of the ones we just did. So we paid cash for equipment $400. So our cash is going down and our equipment's going up. So let's see what we need to do. Let's take the cash first. So cash is decreasing. So we go to our page 9. You can also use page 10 if you wanted. see basically. But page 9 said the asset, we have cash. It's decreasing, so it's going to be a credit. You could also do it on this one. Cash is an asset. It's going down. Same thing. I like this one because it's a little more, it actually has the accounts in. Okay, so let's see. Let's go back to this. Okay, so I'm going to go down here. So I have to talk about some quirks with the journal entries for a second here. Okay, the 25th. So I'm going to come down here and do my credit, and I'll tell you why in a second. Okay, so this is cash. For credits, we usually indent. Oops. So cash is a credit for 400. We usually indent that. You'll see this how it's indented up here. They usually indent the credits. Okay, so we got the cash part. Now we go to the equipment. Equipment increased. Equipment, it increased. It'll be a debit. So you got to keep going back to this thing. And it matters what kind of account it is. You know, so in this case, they're assets. So equipment, it increased to debit. Let's go back here. I put in here that it's an asset going up. Okay, so and here are the kind of quirks to. So these are kind of the quirks to the journal entries that I should probably talk about now. And this is only for textbook. First quirk. Most textbooks, they'll tell you that debits come first. There actually are no accounting rules that tell you that. That's something that they show in textbooks. And in this class, for me, debits or credits, either one can come first. I don't care. As long as the debits and credits are correct as far as what account you're using. But if you put the credits first, that's fine. The reason I bring this up is that if you have another teacher that's using the the online materials on that, they'll actually knock off points if you don't put the debits first. But there is no accounting rule to say you have to have debits first. The next thing is the indenting of the credits. Again, there is no accounting rule that says you indent the credits, but that's normally what they expect to happen. So the indenting the credits is another kind of quirk. It doesn't matter to me whether you indent them or not, but as long as you have the debits and credits, the right accounts, and you're debiting and crediting the correct account, that's fine. However, if you're in another class, just know that those two kind of rules are there and that they knock off points for it if you don't do it exactly like they want it. So, okay. enough of the bad stuff. Now let's go back to the good stuff. Let's see. Okay, so here's our buying land journal entry. And let's see, we already did this. We have, I think we had mortgage payable, right? Oops, I spelled mortgage. We had building. And we have land. I forgot an A in my payable. Okay. And we talked about this before already, but mortgage payable, is it going up or down? Do we owe more money or less money?
We owe more money.
Or more, so it's going to increase. Building, going up or down?
Up.
Up. And land, also going up. So these are all increasing. The mortgage payable is going up, the building's going up, the land's going up. These are all going up. Okay, so let's take the mortgage payable first. Okay. Mortgage payable is a liability, right here. Mortgage payable is a liability. It's going up, so it will increase with credit. So it's going to increase with a credit. Come on. Okay. So I'm going to come down here a little bit. Oh, let me put the date in here. What's the date? February 12th. I'm going to come down here. I'm going to stick to the credits coming last. You can put it anywhere. So this is a liability going up. By 3,000. Let's take the building. Building is increasing. Building and land are both increasing. Okay, so building, land and building, they're right next to each other. They're both assets. And they're increasing, so they will both increase with debits. So land and building, they're both assets. They're increasing with debits. Okay. So land, wait, building first, right? Okay, so land and building are both increasing. We're going to put debits. Mortgage payable is increasing also. It's going up with a credit. It's a liability. Now, I'm sure that you've picked up on something as we've gone through here. this on this first couple or 3 ones that we've done here. And that is the debits and the credits, at least in total, they have to equal. You know, there's 3,000 on this side and there's 3,000 on this side. So the debits have to equal the credits. If they don't, there's a problem. Also, you don't need to put pluses or minuses in here. If it's a debit or credit, whatever, the debit or credit will tell you if it's a plus or minus. For instance, up here, this cash, this $400, you don't need to put a minus in front of it. Having it as a credit automatically tells you that it's a minus. And same thing with this over here, the equipment going up, you don't have to put a plus in front of it. The debit tells you that it's a plus. So you don't have to put pluses and minuses. You don't have to do subtracting and all that kind of stuff. It's simply a quick way. And because debits have to equal the credits, it's a way that you can be fairly sure that you're recording it correctly. And again, this is just somebody's shorthand. This is not, you know, if this is confusing, it should be the first time you're seeing it. So, or most of you anyways, it'll be the first time you see it. Did any of you guys have bookkeeping in high school? There's some high schools that have it. Most of them don't, but there's some that do. So you had it?
Yeah, it's a cool program they just started. This is my junior year that we had to go to the other high school in order to start learning the intro, but yeah, it's like a pilot program that they started to do.
Oh, yeah, good. Very good. Yeah, that's, I don't know why they don't teach it more. It's, because a lot of people go into business for themselves. And it's really just recording the journal entry, you know, the entries of how to record it. But I'm obviously biased. I'm an accounting teacher, but, you know, you would think that it would be taught more, I guess. But yeah, there are some schools that are doing it. Change my camera here.
I didn't really have it in high school, but I did it a lot for the farm back home.
Oh, really? Oh, yeah. I bet. Yeah. Farms is it's a tough business, but it's because you have all kinds. It's actually it's a complex business. You know, farms are actually manufacturing. You're taking something and making it into something else, and it's a difficult. The accounting for it can be quite intense because it is manufacturing.
It gets really long. The year does, the accounting on it.
Yeah.
You really have to look at your operating loan and base everything off that. Right.
Yeah, and then you're the managing of the cash is like the toughest part. Yeah.
Because pretty much when you're out, you're out.
Yeah. All right, so let's see. What am I doing here? Okay, so let's go to number 4. Supplies were purchased on account. So the account we had was, supplies, right? That's one of them. So I'll put that in. Was supplies increasing or decreasing?
Increasing.
Increasing. And an account is probably going to be what kind of an account? I'll give you a choice. Account will be accounts receivable or accounts payable?
Is it payable?
Yep. Yeah. Because we owe them $200 now, so we're gonna have to pay them. Oops, let's spell it correctly. Okay. Accounts payable, increasing or decreasing? This is a tricky one. Do we owe more or less?
Increasing.
Increasing.
Increasing, good. Okay, put a date in there. Did I put a date in the other one? Yeah, I did, okay. So 2/13. Okay, so let's take supplies first. So supplies are increasing. Supplies are an asset. It's going up, so it's going to increase with a debit. Accounts payable increase. Accounts payable is a liability. So coming down here, we have accounts payable. The liability, it's also increasing. It's going to increase though with a credit. So accounts payable, it's going up. It's going to go up with a credit. So again, it matters what kind of account it is. So those are both increasing, but supplies is an asset, so it's going to increase the debit, and accounts payable is going to increase with a credit. And again, you don't have to put pluses or, in there because the credit, for instance, the debit for the supplies will tell you it's a plus. The credit for the accounts payable will tell you it's a plus. Borrowed cash from the bank using a mortgage payable. Okay, well, I'll put the accounts in, and then you guys can tell me if they go up or down. Cash. Cash, is it going up or down?
Up.
Up.
Yep. Mortgage payable, up or down?
Up.
Good, up. We owe more now. So these are both going up. Cash is going up, but our liabilities are also going up. Okay. It's actually similar to this one up here. Okay, so let's take the cash first. Cash is an asset. It's going up with a debit. While we're here, let's go ahead and do the mortgage payable. Mortgage payable is a liability. And it's also going up, but it's going to go up with a credit. So they're both going up. But the asset's going to go up with a debit, and the liability is going to go up with a credit. So again, it makes a difference as kind of what kind of account it is, whether it gets debited or credited. Okay, let's go back. So cash. Here's a liability. And it's also going up, but it's going to go up with a credit. Again, these debits and credits, they need to equal. So if they don't, you take a look at it because you probably did something wrong. Okay. 6. 6 is the tricky one. Issued common stock for cash, and again, issue means that we sold common stock, and the common stock is the ownership. We talked about this already, right? Oops. Maybe we can talk about how to spell it. Hold on. Hold on a second. There we go. Ownership. Okay, so issue just means sold, and that sometimes I thought about issuing debt. That means they sold, the same thing. So issued means sold. Common stock is the ownership. This is equity, an equity section thing for cash. Okay, so cash. Oh wait, I didn't put the account in yet. Okay, let's try that again. So cash. Common stock. Cash going up or down?
Up.
Up. And common stock?
Up.
Good. Okay, so let's jump to our table. Cash going up, and by now you're probably sick of seeing that because it's it's the same every time. So cash is going to increase with a debit. All the assets increase with debit. So cash is going up with a debit. The interesting one is down here, and that is common stock, and it's going to increase with a credit. Sort of like the liabilities. These two are on the other side of the balance sheet. So those two. So common stock will increase with a credit. Okay. And you kind of, you guys I'm sure caught on to the game here that if you know if you have two accounts, and if you know what one of them is, you know what the other one is too, right? If you know that cash is the debit, you're looking at the common stock is fine, but you also just know if the debits have to equal the credits, this has to be the credit, right? And that really is, this system is, once you get used to using it, it's almost foolproof, if you even if you can just know what one of them is, you can make the journal entry usually. Okay, this will be our last one. Last one tonight. Okay, so we have received cash from a customer previously billed. So one of the accounts is cash. And what's the other account?
Payable.
Close.
Accounts receivable.
Receivable.
Yeah. Cash, is it going up or down?
It's increasing. It's going up.
Yep. And accounts receivable?
It's going down.
Yep. So cash is going up. Accounts receivable, they no longer owe us for this $500. So. Okay, so by this time you guys are probably sick of seeing this. Cash going up with well, so what a surprise! It's a debit. The accounts receivable is going down. That's an asset, and this is when people owe us. But if they pay us, they don't owe us anymore. We get the cash from them, and which honestly, the cash is what we want anyways. So they no longer owe us for the accounts receivable. So it's an asset, accounts receivable. It's going to decrease with a credit. Okay. Oh, wait. A little more right in here. This is an asset going down. So this is plussing this asset. The debit is plussing it, and the credits are taking away from this asset. And again, this is just a much quicker way of, you literally just take the 2 or 3 accounts, or whatever it is, and write them down, and you don't even have to do pluses and minuses. Whichever column you put it in will say whether it's a plus or a minus. Well, we're not, we'll stop there for today. Question I guess? Now, again, if this is, I'm going to do something here. Save as working. If this is unfamiliar, it should be. This is the first time most of you guys are seeing this. So if these are awkward, that's normal. Again, this is the first time you see it. And what you're looking at is literally 400 years old shorthand that someone came up with and said, look, I'm sick of writing out all these paragraphs. I'm just going to take the 2 accounts I need, have 2 columns on the side, and that's it. So I can record these transactions much more quickly than, writing it all out. And if you think about it, back 400 years ago, they had the quill, and they would dip it in the ink, and writing was even a pain back then. It isn't just that they didn't have calculators or anything. Writing anything was not fun. So